And welcome to Money Control. You've tuned into weekly IPO wrap, and I'm your host Nikki Mirchandani. Well, the Valentine week typically has it easy for the primary markets, with one Mainboard IPO opening up for bidding, Vibhor Steel Tubes, which opens for bidding on Feb 13th and closes on Feb 15th, alongside Entero Healthcare Solutions, which is already open for bidding this week on Feb 9th, will shut shop next week, Feb 13. In terms of listing, you have 5 companies which will debut on exchanges. Interesting one is APJ Surendra Park Hotels, Rashi Peripherals, Jana Small Finance Bank, Capital Small Finance Bank, and Entero Healthcare Solutions also will list within the week. Well, maximum traction, to bear in mind the fact, was witnessed by APJ Surendra Park Hotels IPO, which got subscribed as much as 59 times on day 3. Jana Small Finance Bank also sailed it through, subscribed by 1.98 times on day 2. Day 3 numbers are yet to be updated, the final ones. Capital Small Finance Bank also saw in full subscription coming in on day 2. Rashi Peripherals IPO got oversubscribed on day 3, led by NIIs and, of course, the retail investors. In terms of SME segment, Wise Travel India opens for bidding on Feb 12th to 14th. It aims to raise around 94 odd crore. Meanwhile, 3 SME IPOs would be coming up for listing: Alpex Solar, Rudra Gas Enterprises, and Polysil Irrigation. But to slice and dice the Mainboard IPO, we're being joined by Prashant Tapse, who is the Senior Vice President Research Analyst at Mehta Equities Limited, and Astha Jain, the Senior Research Analyst at HEM Securities. Well, evening there, both of you. Prashant, coming to you first. What do you make out of Vibhor? It's a manufacturer, steel tube manufacturer. How do you look at this company? It's going to be the 6th public issue to hit the market this month. What stands out for you? How are the valuations stacking up?
I think it is a listing pop for me. A small IPO, which is a flavor of this investors category right now. A smaller IPO gets larger demand, and even the valuations are very much reasonable when we compare to other steel tube manufacturing companies in India right now. What I like in this company is the relationship with Jindal Group, where they are doing it from last 20 years, and they have a long-term contract, which is like next 6 years they are going to supply all the requirements of the tubes for Jindal Steel. That is what the main trigger for me in this business. And the second would be the ratios, which have gone from higher smaller single digits to the higher single digit, like ROC plus 20%. And fourth would be the capacity expansion, which they are going to do it going forward in FY25. So these are 3 points which I like, and based on the valuation, I think it's a distinct pop for me.
Okay. How are the valuations stacking up? Is it at a discount or a bit expensive as compared to the peers, Prashant?
I think it's on the discount compared to the listing peers. Again, the PE is around 16 to 18 times forward earnings annualized, when we compare to other which are almost 35 to 40 times in the listing space. When we compare on the price to book valuation, again, it is coming out to less than 2 price to book valuations, and the industry is almost like 5 to 6 times valuations. So I think there is a good discount being given to the investors who are coming out with an IPO. And I think that is the main reason I think it's a listing pop for me.
Astha, coming to you, 2-decade-old manufacturer that we're talking about. Prashant has laid down some points, of course, which is interesting. But what according to you is the company's USP? What is the downside that the company is looking at? Tell us all about it.
Okay, so talking about this company, as it is into the pipes and all that stuff. So one USP which I'm finding about this IPO rather than a company is that its valuation, which is very attractive. I have just completed my mathematics about it, and according to me, it is coming at a price to earning multiple of 14. That too post issue equity here I have taken, and I have taken FY23. So on that parameter basis, if a 14 is the price to earning multiple against the industry peers, where the price to earning multiples are more than 20, 30, then definitely it looks a very attractive bet in the scenario where we are seeing that the pricing is the main issue for all the main board IPOs. So here its main attraction is its pricing, that is a decent valuation. Apart from that, I have also seen the other financials and I've seen that they have significantly reduced the debt from FY22 to FY23. So their debt to equity ratio has come down. So again, working on the debt to equity ratio, which is going down, coming at an attractive valuation, and along with that, which they have mentioned in their strength also, that is the friendship with the Jindal groups. So that is really helping the company in garnering strong business going ahead, along with the integrated manufacturing facilities. So all these points make this issue an attractive destination to deploy the funds in, provided one get allotment, because the issue size is so small that the chances of allotment will be very, very less.
Asta, if you allow me to add into one more point there, also a very steady financial performance. If you look at that, of course, the debt to equity has been improving. But if you talk about the net profit, is also at 11.33 crore for FY22 and it's grown to 21 odd crore in FY23. Prashant, any downsides that you're looking at for this one?
Downside in terms of risk, I think yes. With respect to the margins, I'm not little bit concerned on that. A 1 to 5% margin would be very difficult, but yes, because of the industry norms which they are into and the relationship with Jindal, they get the confirm orders, but the margin negotiation is very difficult for them. I think they are going to try to build up the margins towards the higher single digit by the way of exports. But I think this margin is the biggest risk right now. Plus, again, they are not able to create their own brands. They are only serving Jindal Group. That also kind of negative for the company right now. But yes, 80-90% of the manufacturing process is only to Jindal Group. But the 10% rest of the business should be created of their own brand, and they are not able to create that. That is the downside risk which I'm looking at.
So client concentration clearly is one of the core issue, Prashant, that you're highlighting. 88%. Has the number come down or it's significantly risen in the last 3 years?
I think 80 to 90, it has been trading around this range only.
Around that range. Okay, so that's pretty much. Asta, would you want to add to any of the negatives? I'm sure you've just had a very preliminary reading and you're yet supposed to get into the detailed analysis. But on the face of it, any risk per se for this one?
So first of all, their agreement with the Jindal group. So in case of any disruption in that agreement, then it will create some sort of issues in the company. So first risk which I'm looking at, and again, if I extend that risk, then the 90% of the revenue is coming from the single customer. So again, that is a concentration of a revenue which even Prashant was also signaling to. I think that is the major risk for this IPO. But if we put all the factors together, I think one should subscribe to this IPO from the listing gain perspective, since the valuations are quite reasonable, along with the small issue size. So I think listing gains can be easily garnered in this IPO.
All right, just to sum it up, both the experts are suggesting issue size is small, margin profile is a bit limited, restricted, revenue concentration is one bit, but the bigger part is the valuation at which the IPO is coming up with, which of course can offer at least a listing pop. Asta, I'm not sure whether you'd give a long-term rating for it or no, but Prashant at least has given it just for subscribe for listing pop. What's your assessment on the just surface level?
So yes, subscribe for listing gains is also recommended from our side, and I think even in the long term also this issue can give some sort of a returns, provided the listing premium should not be that high that in the long term returns can be generated on the very single day. So we have to look that factor also very closely. So I think in the long term also it can generate the returns, provided by, I mean, what are the objective of the issue? If they able to help their financial performance improving through those objects, then definitely in the long term also it can perform. But yes, for the short term, that is listing in, as well as long term perspective, we are recommending this IPO.
Right, Prashant, any grey market premium indication for this one? Vibhor steel tubes, because Asta has clearly said that if it's a sharp uptick, then probably you'd want to wait and watch before going long, just for the long-term basis, subscribe on long-term basis. Any indication there?
I think with 70-80% is the range what grey market is suggesting in the market right now. But it should not be the only way to look at and then subscribe the issue. But only the valuation is the biggest attractive things one should look at while investing. Gray is giving a 70-75% range of listing gain. And if it is this at these levels, I think long term will be very difficult. And if it gains around 50% plus, then a long term investor can think of holding it for at least more than 1 year.
Okay, so if the listing premium is above 50%, then you would probably give it a subscribe for longer term. But if it's in the range of 75 to 80%, you would perhaps just ask them to cash out, if at all, if they manage to get the allotment in the first place for this one. But I'm going to switch on to the second Mainboard IPO for the week, which is Entro Healthcare Solution. It's a 1600 crore IPO which opened for bidding today. 1,000 odd crore comes from fresh issue to fund the working capital requirements. 600 crores comes from typically the OFS. But the only limited point that I personally felt was a little downside was A, the valuation, B, the loss making company. These were some of the two negatives. The margin profile also was pretty range bound. But what do you two make out of it? Asta, you can go first here.
Yes, you are absolutely right. The loss-making company, but the major reason behind the losses was their investment because the historical track record is not very long. So they have come into existence, I think, recently. I mean, 4 5 years back, if I'm right with my figures. So I mean, in that way, they have invested sharply, and that is the one of the reason. That's why we have seen some sort of losses on their book. But in the H1 of FY24, they were successful in posting the profits. And in fact, one more point that the operating profit was positive, and they were on the positive side if I talk about the operating profit of last 3 to 4 years. So talking about this company, valuation is the major concern for me because at 1258, which is the upper end of the price band, the valuation seems to be very, very stretched. It is more than, I should say, 150 PE multiple, which seems to be very stretched. So it is one of the concern. Although this business is sort of a business which is a volume based, and now one of the objective of the issue is to repay the debt. Now, what happens with the debt which they are going to repay? About 70 to 75% of that is into the working capital. So definitely that will help the company reducing the interest cost, and which will directly add to their bottom line. So definitely going ahead, also this company will be able to post the profit. But again, I have done all the mathematics, and if I add my profit figures again, then also, I mean, looking after the valuation, it looks very stretched. So this is one of the concern, and that is why we are recommending only for the long term subscribe to this issue. If one want to take the risk and they go for the listing in, then they can go. But our main subscription rating is for the long term because we find valuations to be very expensive.
Sure, Asta, if I could add in, cash flow from operating activities is also negative for the last 3 years. The company, we spoke to the management today, they seem to have very aggressive plans when it comes to their growth. Inorganic expansion is what they continue to look at after scaling in or lapping up companies over the last 3 years. How do you find the growth strategy per se?
So growth strategy is quite good. This is what I can say. And now, as I've told you, because what happened, this working capital, which they will be, repaying through the object of the issue, that will help the company in garnering the more margins. So the total plays of the operating leverage in this sort of a business, where we see it is more or less like a trading business or into the distributorship business, where you cannot work more on the margins because I mean. The margins will gonna be same. So here, what the beneficial to the company in the long term is the operating leverage because the more volumes they will be able to garner, the more discount they will be getting from all these companies because they are the distributor between the pharma companies and all. So they will get the more discount. And if the more discount they will be getting, then definitely because the fixed cost is high, so definitely it will be helping in creating operating leverage. So all in all, it is all a long-term story. We really need to see, although management plans are very strong, they have shown strong CAGR growth also, because if I look after the CAGR growth also, it is very strong. So, I mean, but we really need to see how the company will, walk the talk. So in that way only, I have recommended it for the long term.
Sure, 36% revenue CAGR from FY21 to 23 is what the company looking at, and perhaps also looking to outperform those numbers. Prashant, what do you make out of it?
I have a different view on this. See, I'm very much neutral right now because of the valuation concerns. Not able to give even avoid a kind of recommendation to this IPO. My concern is with respect to again very thin margins in the distribution business. Plus, the company has grown from last 6 years by inorganic way. That is, they have almost acquired 30 to 35 companies every from last 3 4 years. So that is the concern which I am looking at, because their growth and the CAGR what they are getting is only because of the inorganic growth. Organic growth is very slow, and I think it will take its own time to mature and give good fruits out of that. The very much concern would be the business model which they are doing it. From last 6 years they have grown faster, but going forward I have a doubt again how they will be growing. And the inorganic growth is the only tablet they have to grow, but margins they have nothing to do with that. The very thin margin of 1.1 to 2% is a very concern, and any disturbance going forward will bring them to losses again back to their old historical levels. So concern about this IPO, I have a neutral view right now, and no perfect reading on that.
Prashant, just taking your point forward there, if you look at the percent at which they have grown, 36% revenue CAGR, the management has given a split. They're saying 22% will be coming in from organic, or rather has come from organic, and the remainder 14% has come in from inorganic. And they continue to believe that organic growth will be the way to go forward. Do you actually believe, you think that that is a thing which is playing out even on the financials, or you think it's a bit of drag there?
There is a drag on this. I think even I had a discussion with the management, the way they are planning their strategy to grow. The way they said inorganic growth has given them a little bit of growth, but again, those are again loss-making companies as of now, right now, and that will be eating up the profits of the organic business they are doing it. So on a consolidated basis, again, I am seeing very thin margins, or even they can go back to their losses going forward if they're not managing the strategy very well. So concern about that, and with that, we have a very neutral view on that.
Okay, neutral for long term, and Asta has a buy rating, but of course, subscribe rating for long term, not chasing the listing pop here, right?
Yes.
Asta?
Sorry, I'm not able to
Okay,
hear you
Asta,
properly.
I just asked whether it was a subscribe rating on long term basis for this one.
Yes, only for the long term, and that is only for the risk taker investors.
Okay, Asta, I'd also want to understand from you. Also, we're seeing more listings coming in when it comes to Mainboard, right? APJ Surendra Park Hotels IPO, which got subscribed as much as 59 times on day three. What do you think about that? You think it's solid premiums coming in on that one? What do you like about this company?
So APG Surendra Park Hotel, first of all, we have recommended subscribe to this IPO for the listing gain as well as long-term perspective, but for the limited listing gain. So here one or two points were quite positive. First of all, I mean the sector which they are into, that is they will really get the boost from that sector because industry tailwind is there. And apart from that, the occupancy ratios were very strong for this particular company because they were working on the 90%, more than 90% occupancy, which is one of the highest occupancy ratio among the peers. So that is also making this company an attractive issue. Although on the valuation front, it was a fully priced. I should not say that it was a reasonably priced. It was fully priced, but looking after its fundamentals, the industry tailwind, and the fundamentals of the hotel in particular, we have recommended this IPO for the listing gain perspective. And I think on the listing day also we can see some sort of premium on this company.
Okay, after 2 points there, sure, higher occupancy rate, but also if you look at the margin profile of the company, it seems to be a little bit higher as compared to Lemon Tree and, beg your pardon, a little lower as compared to Charlotte Hotels and Lemon Tree. How do you view that? Do you expect the margins to kind of outperform given the kind of occupancy rates which are incrementally growing? How are you looking at it?
Yes. So yes, if we talk about the margins, but I think they are definitely not that much attractive if I compare it to the other peers. But going ahead, I think the company will be able to improve their margin profile also, given the kind of occupancies we are seeing. Apart from that, this company is also on the expansion. They are into, some more hotels also. They are coming with some new hotels also, new projects also. I think going ahead, all these will help the company in posting strong financial performance. So yes, we are positive on this IPO. We were positive on this IPO, and right now also we believe that going ahead also the company will be able to post strong financial performance and improve their margin profile.
Okay, Prashant, what is the gray market premium indicating? What do you don't like? I mean, we've already factored in enough positives. Tell me, what do you not like in the park hotels?
Even I have a long-term holding rating on this. What I don't like is again some part of OFS is the part of this IPO. Again, second, any delay in the projects, what they are going to plan going forward would also affect their revenue per room going forward in next 2 3 years. Third thing again, because of the restated losses in the historical levels, that will be a concern for a new investor to come in and keep in their money for long term. And significant revenue comes from the corporate and other revenues. Any changes in the business travel or the segment where they are into, the place they were into, that may also bringing some kind of pressure in the business. The same way the trend has changed last 3 years back, and then they have made some losses. So now they have come up with 8 to 9% of profitability right now. But again, there is a little bit of risk. The margins can go down if something goes wrong with their expansion plan.
All right, both of you, just 30 seconds on this one. Jana Small Finance Bank or Capital Small Finance Banks? Which is the one that you're betting on? Prashant, would you like to go first?
Yes, I'm neutral on both. The industry is very much consolidated right now. No valuation. Both are almost similar to their businesses. Only the state of their business location difference. But I think from last 2 3 5 years, where any small banking finance have not done great in terms of giving returns to the industry, to the investors. Again, I think I have a neutral view on both. Not recommending anything on this.
Okay. How about you, Asta? Jana Small Finance Bank or Capital Small Finance Bank?
So looking after pure valuation perspective, I find Jana to be more attractive because they have came out with a price to book multiple of 1 on the post-issue equity basis. So this is one of the major attraction. One differentiating point between both of these is their secured lending, where the Jana is into the 57% of their gross advances into the secured lending. Capital Small Finance Bank is more than 90% of their advances into the secured lending, which makes the business very safe. So this is one point to look upon. But talking about Jana, they have already have a strong presence and a pan-India presence along with a strong management. Mr. Ajay Kamal, he is a very dynamic person. So I think the management is very strong in the case of Jana. They are moving towards now towards secured lending because it was once upon a time they have started with the microfinancing business. So they are on the trajectory, although in the historical track record, if we see the asset quality was the major concern. So if the management is able to improve their asset quality, I think because when I see the ratios like ROA or ROE, then Jana is really have posted very strong ROEs of around 16%, ROA of around 1%. So that is looking very strong to us. So if I talk up between both of these banks, I think small listing gain can be expected on the Jana Small Finance Bank. This is what we have recommended our client also. Only for the small listing gain, don't expect big out of it because the NIMs are a real concern for me because the net interest margin as compared to the other peers were on the lower side for the Jana. So that is one of the major concern and the asset quality was the another concern. But from the valuation point of view, because they have kept the valuation low, so we have recommended it for very small listing gain or a limited listing and for the long-term perspective also.
Brilliant point and differentiation made there. Jana is for management purpose. Capital is more towards the books on account of the secured lending. Of course,
Right.
NIMs are expected to also contract for Jana. Maybe a bit of difference there because as it moves or transition more towards the secured lending. So that's a bit of
Right.
concern there. But last point that I would want to ask Prashant, coming on this one, Rashi Peripherals. It's the company which is backed by Madhuri Madhusudan Kela, which is, of course, a big name there. It's got oversubscribed on day three and it's also going to be listing in. What's the expectation? What's the gray market premium suggesting? And what do you expect?
So I'm expecting a listing gain of around 20 to 25%, mainly on the back of again the business model what they are into. Almost the leader in terms of distributing all the computer-based equipments in India and servicing all the big brands about the laptops and the other equipments in computer systems, and backed by the family of Kela family. So that is the only reason why the premium is being garnered at 20 to 25%. I think the risk would be again on this would be on the margin side, where again 1 to 2% of PAT margin is not comfortable for me, and the business model is great but sustainable. But for me, if they are going to give you a 20 to 25% listing gain on day one, I'm out of this for profit booking.
All right, Asa, 30 seconds on this one.
So we have recommended it for the small listing gains also, because what I find positive about this company is this setup. I'm in 63 warehouses, and I'm in 600, more than 600 locations. So I mean the setup is very, very strong, and serving around 8,000 clients, working with the 53 global brands. So the setup is strong. Historical track record is quite strong because the company has a history of more than 30 years, and their financials are okay. Although I know that because being a trading business, the only driver is the volume. So if they will be able to increase the volume, then only they will be able to improve the financial performance. There is no other way to show the increase in the financial performance, and margins will not going to be increased in any case. But if I see the peer, that is the Reddington, which is also going at the same P multiple, so we recommend Rashi, but just for very small listing gain. And this is what we have
All
recommended, Rashi.
right. All right.
Yes.
Both of you pretty much hold the same view there, but barring one IPO where there's a bit of dichotomy in views there. But we're just going to leave it at that. And thank you for taking out the time and having this conversation. Hope it was a fruitful one for our viewers. But with this, it's a wrap and goodbye from us. Thank you so much for tuning into Money Control.